Hi everyone. Today we have a very interesting topic. It's been trending for a long time now. And basically, we will look at what's been happening to gold and silver, what the expectation should be, and what should an investor do right now. Okay. So, gold has seen a solid price increase, and all of it has come due to certain factors, which we'll take in the next couple of slides as well. But this is overdue. And if you see over cycles, you do see that precious metals tend to outperform broader equity markets and as well as other asset classes like debt. But this is not unknown. This is definitely a known thing. And today we are in that phase of precious metals doing far more better than that of other asset classes. Now, one important thing, when you look at it from a risk perspective, you look at the chart, it's just a one way up. Now, this is an extremely risky venture, and investors definitely need to be a lot more cautious. Right. What is the other thing that investors need to look at in terms of caution? This entire webinar is only to make you aware of what risks can come up. What should you actually look for if you're on that path? What do we look for all the time before we take a particular call on new? Right. Now you look at the margin for trading gold and silver, right? So over the last couple of weeks, we have seen that Shanghai, we have seen India, they've all increased their margin requirements, which means they're making it more and more expensive for newer entrants to come in and participate in contracts. Like this makes it, which means that they want some amount of uh, normalcy to come into the picture, where these premiums start to go away, a lot of speculative activity starts to go away. This is why you're having entry barriers to be very high, right? But is this a common thing over the past? Yes, this is definitely a common thing over the past. We've seen it happen in gold in 24, 25. We saw it happen in silver now. And this will be a trend going forward. Why? Because supply is very low. So the physical market is extremely very high. Right. Okay, there's a question. Yesterday again, uh, sorry. Yesterday, CME once again increased the margins to trade. Yes, they do this to make sure that the person entering into the market is not of speculative nature. They are all serious players that come into the market. They want limited participation. Hence, the expectation is that it would tend to normalize. Prices would start to normalize. Premiums should start to go away, is what the expectation. These acts usually determine only that. Now, what has been the key trigger for such commodities, such a surge? One thing is the narrative of a weaker currency, a weaker dollar. Now, dollar has been very weak since COVID, and the idea has always been that over the last 5 years has been to make the dollar a lot more competitive in the global markets. Which means keep it cheap, keep it below its fair, keep it undervalued, so that people can continuously park money into treasury, right? But what is happening now is that people are moving away from treasury as well, right? Hence the need for an alternate currency has come up, where central banks have been plowing more money into gold as a commodity, and silver also starting to come in as a commodity, where because of all these geopolitical tensions and trade wars, to protect their own currency as a hedge. So understand that safe havens. I read an article that said Goldman Sachs predicts the safe haven gold to touch 6,000 odd dollars by the end of the year. So understand that it's a safe haven for central banks. It's a hedge. And these are not short-term hedges. These are all long-term hedges. And these hedges have been in place over the last 10 years. So that level of de-dollarization has been taking place over a good amount of time. It is over decades. It's not just a trend that has taken place in 1 year or 2 years or so. Right. So this has been that trigger where now people are taking cognizance of the fact that yes, this is a metal where now the need for a hedge is extremely high. So such metals are extremely valuable. Right. Now, is gold always going to be a safe haven? No, it is not always going to be a safe haven. We have seen very big drawdowns that have come in. If you see in 17, it's a 40% drawdown. You see during global financial crisis and post, right, during that 12, 13, 14, you see huge drawdowns coming in on the gold and silver part. Right. Silver particularly will have higher drawdowns. So I'll take you to that slide of, uh, let me take you here. Okay. You did see a daily drawdown of almost 30, 35 odd percent, which is beyond plus two standard deviations. Basically, these are not events that have taken place. The expectation of such events to take place is not fully priced in. Hence, when too much optimism starts coming in, we have to take a stance to say, let's be a lot more safe, let's be cautious. And as investors, that level of rationality has to come into you. Silver, majorly, the fundamentals had already been priced in, right? And most importantly, if you see this, right, at a particular price, when the prices go up for commodities, the new supply starts coming in, right? There is more capex, there is more activity, there's a lot of metal that comes out of the ground into markets because they have to serve and service those particular contracts. So when more supply starts to come in, that narrative of supply is constrained and demand is always going to be there. But at those prices, every miner will want to make money. Hence, that little increase in supply starts coming in over a period of time, which does not make the high price justified, right? And the demand also starts to go away at those prices if supply doesn't come in. Then manufacturers start to look at alternatives. So silver already has an alternative that's there. So extremely careful is what investors need to be. It is not one size, okay, I put money here and it will consistently compound. No, it's not like that. Every asset class goes through a particular cycle, and it's a very strong cycle that we've had for the precious metal. Are we at the end of the cycle? Cannot say. Has the cycle broken? Again, cannot say. We all have to just observe and see what activities are starting to take place in the market for us to determine whether what part of a cycle we are in. When we had started investing for Neo, we understood that we are at the early stages of that particular cycle where things were looking very cheap. Now, because the premiums have gone up, it does seem that okay, there has to be some level of normalization that has to take place. Now, if you see, our ETFs also have had a stellar run. Your Nippon and your SBI, these are basically your ETFs, right? They've all had significantly stellar runs, but also they have seen a good amount of volatility that is there, right? Now, can there be a case where one asset class does well, while the other asset class does not do well? We had a phase in 22 where equity went down, precious metals also went down, debt also went haywire. So traditional economics does say that no, there will be one asset class that always people will go into. It comes with a lag, but longer term trends tend to stay, right? So don't get swayed away by short term trends, or don't make any analysis to say, hey, if gold is going up, then that means equity is going to fall further and all that stuff. We've already seen a good amount of fall that has taken place on the domestic equity part, right? So always have to readjust uh, narratives, get accustomed to what's happening today and start looking only forward, right? So we have to take this into consideration that there can be a case where this does not do well going forward over the next 6 7 years or so. That can also be a thought that should come into you as an investor. That is why we say that when we look at investing, we look at it from a fair, cheap, very cheap, fair, expensive, very expensive sort of valuation bands for all the asset classes that we look to invest in, right? Now, in terms of uh, behavior that the central banks are showing, today central banks, foreign central banks now own more gold than they own US treasuries, and that is a very solid trend. So here we see demand coming in very strongly from central banks, and that is a trend that we expect can continue to stay over the next decade or so. So we will never look at such 1 year, 2 year sorts of behavior from for particularly for precious metals because it relates to a lot of supply, right? And we will only look at it from a very long term perspective. So yes, this is the trend that is continuing to happen. Interesting part is if you see from 2000 up until 2010, very less was the allocation of foreign reserves as part of central banks towards gold, and that has been inching up very fast. Hence, that increase in the price of gold. Now, there's one more addition that is coming in right now for the price of gold. So long-term structural demand stories remain intact. India is going to be a consumption nation for gold. It's more sentiment driven. China again is going to be of the same sort. So demand seems to be there. Only the contributors to a price increase keep changing. Right, 23-24 was a period of central banks contributing. 25-26 was a period where ETFs have been majorly contributing, which is more retail and more speculative oriented. So it's basically chasing the past winner. And what happens when you chase a past winner? You don't usually say that the past winner is going to be the future winner as well. Our approach to risk management is to just take some money off the table and go to the next part of opportunity where asset classes are undervalued, right? So Neo has that option to move very flexibly from an overvalued asset class to an undervalued asset class. Okay. So let's look at some parts of Neo as well. Now, how do we approach gold and silver now? Now seems to be a point where normalizations are taking place. It is still not at a place where we can take a conducive call to say, yes, this is very, very attractive, nor is it very, very expensive. It does seem to be more on the between the fair to expensive sort of category that I was talking about. But going forward, we will definitely be on watch to see what are the trends that can take place. Uh, for particularly for Neo, we have been investing in gold and silver since the start of this strategy, since inception. And over the last couple of years, we have been scaling back our allocations towards precious metals over the last couple of months, not years. Uh, and we are already on the way out. Right. So Neo's framework is very simple. We don't have any cap on any asset class. We do take a top-down and a bottom-up approach on all asset classes. Plus, there is a concentration across themes with a market leadership bias. Right. So we will always go towards market leaders, particularly on the equity part. And for calls like precious metals and other asset classes like debt, REITs, InvITs, we do take a top down plus a bottom up approach. Now, how did we come up with that idea that we need to allocate money towards debt and towards precious metals, and how much of it do we need to allocate? So back when the strategy started in 2022, we looked at it from one particular idea to say, okay, we need to have an alternate currency in the portfolio because we do expect that the currencies would remain weak and the dollar has to be competitive. So that became for us a top-down opportunity to look at. Then we looked at it from a passive and an active oriented strategy. Now, precious metals is such that require some amount of activity because it definitely goes through cycles and we do not want to be on the wrong part of the cycle. So we took that call of having an active strategy and investing more towards precious metals. Now, how did we determine whether we need to invest more or less? That again comes on how we look at macros. And when it came to macros, it did seem that there is a lot of geopolitical tensions. There is a lot of tariff related issues that can come in. And we were at that point where Ukraine and Russia war was starting to take place. So we did feel that this metal seems to be very undervalued right now. Yields are also shooting up. Inflation is also going up. And currency seems to not reflect that part. Our expectation was that dollar would remain weak, but it was not reflecting. Today, it is after 4 years in terms of reflection. So we decided that we should do, in every portfolio, something around 10 odd percent, which was going into gold and silver. So 20% of that portfolio that was built. And for all investors who came during that phase, right, it was a 20% odd sort of position. How did this sort of evolve? Now, for every investor that comes in, we will always look at it from an opportunity perspective, right? So when sometimes the investor would have somewhere around 5, 7, and when gold would start becoming attractive, that would go up. So every portfolio that we build is based on opportunity, is based on what level of allocation that we need to do during a particular phase in the market. Right? So somebody who came in today versus somebody who came in 2023, their portfolios would drastically look different. But over a period of time, they would start looking as one particular basket. Right. So for somebody coming in now, for example, there will be zero allocation to precious metals. Whereas for somebody who invested with us in 23, they would have a slightly higher, but their behavior would be more from a reduction sort of standpoint. So every portfolio that we build is going to be extremely unique to opportunities that are available and to the particular investor based on their risk profile. Right. Now, something similar that we have done on the equity part, we looked at it from a top-down approach, and then we saw that passive is the best way for us to take that particular basket, and it was more to do with public sector banking because public sector banks at that point were trading very, very cheap compared to that of private banks, and the growth that was taking place in infrastructure plus the credit growth that had to take place, it was majorly going to be fueled by public banks first, and NPAs were very low, and they were well capitalized, and the government, despite COVID, our banks were extremely resilient. We were coming off the NPA crisis, and banks were getting capitalized by the government even before COVID started. Right, so we were very, very ripe to take. So when we look to invest, it is more from a staggered approach in and a staggered approach out. We take time. It takes us about 1.5, 2 years to build this position. Gold and precious metals also is something that it took us time, almost 3 years, for us to build a very high conviction sort of position in every individual portfolio that we manage, right? And it's a staggered exit out. It can take up to 6 months. It can take up to 7 months. It can take up to 2 months also for us to exit. We have seen that we've been able to exit immediately in a month or so because volatility has been extremely high, and valuations also have gone parabolic. So we will look at it from a valuation lens also. We will look at it from a fundamental lens also, and then take that call for every particular asset class. Right. Our whole idea is to build versatile portfolios that prosper in all markets. So if you ask us when is a good time to invest in Neo, any time is a good time for us to invest in Neo. Right. And this is predominantly for non-resident Indians because of all the compliance and regulatory problems that are there. For somebody who is a resident Indian, for them, there is another multi-asset strategy called Sphere. Both are managed by the same team, which I'm a part of. So it's just that certain calls we will not be able to take on Neo, which is predominantly related to mutual funds. But more or less, the philosophy and the direction would be the same. Just that the products would be different on how we take it. Right. If you look at how we manage drawdowns, since inception, we have seen a good amount of drawdown, but much better than the Nifty, slightly more aggressive than the multi-asset index that we are benchmarked against. Right. So Neo has seen somewhere between 10-12% sort of drawdown since inception, but much better than that of the Nifty and slightly aggressive than that of the multi-asset. Right. In terms of expectations, what should you actually expect from Neo? See, Neo is a strategy. Since it's a flexible multi-asset sort of a strategy, we expect somewhere between inflation plus 5 to 7% as long-term expected returns that an investor should get if they choose to invest in this particular strategy. Right. We might have very good years and one particular asset category does extremely well, or we might have all years that all asset classes are doing very well, like what happened in 24. Right. But our expectation is that during such situations, we laterally shift between asset categories and asset classes to move towards undervalued and build the next phase of growth assets. Right. So that transition would take us a bit of time. Hence, our expectation is average inflation plus 5 to 7% sort of returns over a long period of time of 7 years plus. Right. Minimum investment is about 50 lakhs, and we are benchmarked against the multi-asset index fund. Fees are fixed. It is about 1.5% per annum, which is calculated on a daily NAV basis, charged to you quarterly. Right. The ideal investor that we would like to work with is someone who has a 5 to 7 year sort of horizon, and definitely this is not a product which is extremely aggressive. This is a product and a strategy where it operates between conservative to moderate. So it fits more or less all investors with this particular category. We don't see too many investors where their risk profiles are extremely aggressive because volatility takes away all of that, and then we realize that they are moderate. So moderate to conservative is what is the risk positioning of this particular strategy. Thank you so much, guys. Thanks.